a lot of people ask me questions about, Sergio, you're trading options. Great. What are you buying? How are you figuring this out? Okay, this is more of a evergreen kind of a topic. So when I first started the channel, I recommended you guys books. Hopefully you bought the books and you read the books, so we're kind of at the same level. Not the same level, but you at least understand the lingo, right? The expiration date, strike price, right? Underlying asset, the implied volatility, the Greeks, the deltas, the gammas, the thetas, and all these things you guys hopefully learned and understood a little bit, so it's not going completely over your head, right? So, but people go like, yeah, but you're saying this, but how are you deciding which option to buy? Because when I look at my option chain, there's thousands of them. There's 0 DTE options, which I think the degenerate gamblers use those. 0 DTE, 0 days to expiration. There's weekly options. There's regular expiration. I mean, there's unending options, and option trading in this country has absolutely skyrocketed. I mean, everybody and their uncle is trading options, knowing and not knowing. In fact, I put a poll up on After Hours. I said, what kind of strategies you guys use? I put up 4. And by the way, 90% of option traders lose money, or most traders lose money. And so the 4 choices were, I buy premium, meaning I buy puts and calls straight up, right? Number 2 was I sell premium. Number 3 was I do spreads, right? Put bear spreads and bull spreads. And number 4, I have no idea what I'm doing. I'm just gambling, right? Guess what? 90% outside the I sell premium, 90%, it totaled 90%, right? So if you're buying puts and calls, fine. You're putting a directional bet and a durational bet. You need to know which ones to buy. So people go like, Serge, you should talk about that. Like, yeah, you're buying, but how you're deciding which one to buy? I'm like, okay, so today I'm going to talk a little bit about that. How to pick the right strike price and how to pick the right expiration. Well, it all depends on my time horizon. Okay. If I think a stock is going to move on a catalyst, for example, let's say earnings, right? Why would I go buy like a 6-month out option? I wouldn't. However, being a position trader or a swing trader, I always try to buy a month out regular expiration options, which expire on the 3rd Friday. So September is September 20th. Now, they have other options in between. The second thing I look at is within these next 30. So when you're buying an option, when you're buying premium, you're like spending premium, paying somebody premium, because for the buyer, there is a seller on the other side, right? So when you're buying an option, right, either you're gambling completely as a degenerate with 0 DTEs and whatever, and you can make a ridiculous amount of money, but most of the time they're going to hit the wall and expire worthless. The point I'm trying to make is, what is your, then you look at the catalyst that's coming up. Do they have earnings? Is it going to move? Whatever. But then you look at your charts, right? Pictures are worth 1,000 words. So, for example, the past trades, we had an amazing trade on Tesla. We had an amazing trade on AMD, right? So I was thinking Tesla, if it broke 185, will move to 220 to 240 levels within at most a month. So why would I go buy 2, 3, 4 months out options? Why would I pay more premium? Because the further you go out, the more premium you're going to pay. They're going to be more expensive. Well, sure enough, Tesla, before the crash, broke out 185. It went to 285 within less than 10 days. The options I bought for $5.25 each. So each option is 100 shares. So that's $525. Went to 28 because I wasn't buying the 185s. As far as the strike price, I was buying the 220s, which was a little bit below my target on a breakout, right? So I consider, as a position trader and a swing trader, okay, I consider what kind of move I'm expecting and how soon I'm expecting it, okay? Now, if you're buying premium, you have to be right in 2 things. You have to be right. You have to be right in the direction, obviously, and you have to be right in the duration. So if your setups are correct on your charts, right? If a stock has been going sideways for 4 months and on a breakout, what will happen? That's the consolidation phase. It's going to break out, move 30%. That's when you go by, decide how far of an expiration date I'm looking for and how much of an out of the money strike price I'm looking for, right? So those are the two top criteria. Obviously, I look at the Greeks. Obviously, I look at the general implied volatility. Obviously, I look at a couple different things, but you have to understand when you're buying premium, when you're just buying puts and calls, puts meaning you're betting for the stock to go down, calls meaning you're betting it to go up, you need to figure that out. You need to look at your fundamentals and obviously look at your technicals, right? What kind of move I'm expecting, how soon, and hope that you're right. Obviously, if you buy an option expecting a 20% move in the stock, the underlying option is going to move a lot more than that. And in Tesla's case, they went from 5 to 28, the options that I bought. Okay. Did I buy it at the low, sell it at the high? No, but you guys can see how levered they are. Tesla moved $100. The options moved 5x, right? So long story short, you have to be right in the direction and you have to be right in the duration. And as a swing trader, I always look at a month out, always. If I'm going to make a directional bet, I always look a month out because the setups that I'm looking at are about to break out or break down. So on a breakdown, you buy the puts, obviously. On a breakout, you buy the calls. The strike price of an option is the price. We know what that is, right? We should be on the on the same wavelength here, right? So there is strike price, the stock price, implied volatility, in or out of the money. We should know. We should have all this lingo, okay, set up. And the good thing with buying calls or puts is limited risk. You cannot lose more than what you put up, as we know in options. So, you could be a degen gambler, buy weekly options, zero DTE options, or you could wait for a good setup and then my rule of thumb, again, I go out about a month out. So if I'm like right now, we're August 16th. Well, the next monthly expiration is September 20th. On the next one, I think it's October 16th. You can go September, October, November, December. You can do that. Now, if you're thinking that, well, yeah, this stock has been going sideways for a year. When it breaks out, the move is going to take about 4 to 6 months. Then you're more than welcome to go buy a 4 to 6 month out option, pay the premium, because then you can hold on to it, right? But what I do is that I still go a month out, and then there is something called a rollover. So I will buy it if the trade is working properly when I have about a week left on the existing contract. I will sell those and I will move my strike price up because stock has hopefully moved in the direction that I was hoping it would move. And then I will roll them up. I will roll them up on a month basis. But if you're not in that thought process, then you can buy a 4, 5, 6 month out option, out of the money option, right? And there's no, some people like buying at the money options because there is that much premium in it. But when you guys understand this, when you're buying an out of the money option, out of the money meaning, let's say stock is 10 and I'm buying a $15 strike price, stock has to go to 15 plus the premium for me to break even. So in that case, if the stock stays between 10 and 15, time decay is going to absolutely wipe me out, right? So you have to understand that when you buy an at the money option, your delta is going to be point for point almost from the get-go. Delta meaning how much the underlying moves and how much your option price moves. That's why you guys got to go learn the Greeks. So there is many variables, but for keeping it simple for this segment, I go usually a month out if the setup is such that I like, okay? And I go at least 3 to 4 strike prices higher because I'm expecting a big move out of that setup, okay? Or our favorite Nancy Pelosi usually buys way deep into money options because she doesn't want to pay all that extra premium, time premium. So there's two things in an option: intrinsic value, right? What it's really actually worth, and time premium. You guys have to pay attention to both. Everything you're buying out of the money on an option is time premium. There is no intrinsic value. Okay. And time, if the stock doesn't move in the direction and the duration you're hoping it will move, that option will expire worthless. That's why 90% of the people lose money trading options. So that's that. Hopefully you guys figured that out. But that's my rule of thumb. And then, determining your risk tolerance, obviously. First of all, the key is to identify a good setup. Okay. You don't have to buy and sell every single day. Don't be a hummingbird. What you can do is identify a good setup. And I've shown you guys this many, 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 many times, right? What's my best setups? Best setups are something that's been going sideways for a while. You play you buy the calls on a breakout, you buy the puts on a breakdown. So once that happens, you place your bet, you made a directional bet, and then you just hold on. And that's all I can tell you guys as far as which option to pick when.